Welcome to lecture 2 of our financial series. In our previous session, we touched upon the basic necessity of maintaining records. Today, we delve into the heart of financial management, the distinction between bookkeeping and accounting. For many, these terms are used interchangeably, but in this profession, finance, they present two very different stages of a single process. Think of it in this way: if a building is a finished financial report, then bookkeeping is the collection and laying of the bricks, while accounting is the architectural design and the final inspection. Why is it vital to distinguish between the two? Because one provides the raw data, while the other provides the meaning behind the data. In this lecture, we will deconstruct these processes, explore a comprehensive comparative analysis, and define the essential vocabulary that every business professional must between the roles and responsibilities of bookkeeping and accounting. Second, you will gain a deep understanding of 26 fundamental accounting terms that form the language of business. Third, you will be able to visualize and explain the sequential relationship between business transactions, the trial balance, and final accounts. Finally, you will understand how these processes culminate in the analysis and interpretation of a firm's financial position. Our goal is to move beyond rote memorization and towards a functional understanding of how financial information flows through an organization. Let us begin with the first pillar, bookkeeping. By definition, bookkeeping is the art of recording in the books of accounts the monetary aspect of commercial or financial transactions. It is essentially the recording phase. Every time a sale is made, a bill is paid, or a sale it will crumble. Have you ever wondered what would happen if a zero single Have you ever wondered what would happen if a single zero was missed in a single ledger entry? The answer is simple. The final balance sheet would fail to reflect the truth. Therefore, bookkeeping requires precision and consistency, even if it does not require the high level analytic processes. Moving upward in the hierarchy, we reach accounting while bookkeeping ends with the recording and balancing of ledgers. Accounting begins where bookkeeping ends. Accounting is the art of recording, classifying, and summarizing transactions and events of a financial character, and the most importantly, interpreting the results thereof. It is analytical in nature, and does not look an accountant does not just look at the list of expenses. They analyze how those expenses affect the company's probability differentiates more clearly. Let us look at the comparative chart. First, let's look at the definition and posting. As we established, bookkeeping focuses on the art of recording monetary transactions or aspects. Accounting, however, takes that recording and adds the layer of classification, summarization, and interpretation. When we talk about posting, a bookkeeper's job is to move entries from the journal to ledger. This is a mechanical process. On the other hand, the accountant's role in the posting is one of oversight. They examine the postings to ensure accuracy and completeness made during the recording phase and prepare the financial statements that tell the story of the business's health. If bookkeeping is about what happened, accounting is about what does it mean for the future of the company. Defense against the data entry errors. This leads us to reflective questions. Is it possible for an accountant to do their job without a bookkeeper? In theory, yes, but in practice, it would be high inefficient use of specialized skill. The accountant relies on the bookkeeper's output to perform their analysis. Next, let us consider the nature and scope of work. Bookkeeping is clerical and routine. It is a daily task that follows a set of established rules. Accounting, conversely, is an analytical and requires significant professional skills. The scope of bookkeeping is limited to the maintenance of books of original entry and ledgers. However, the scope of accounting is much wider. It includes the preparation It includes the preparation of final accounts, namely the trading account, the profit and loss account, and the balance sheet. It also includes the analysis of these accounts to provide insights to stakeholders. While the bookkeeper is concerned with the how of recording, the accountant is concerned with why and what next. A critical point of comparison is dependence and spatial knowledge. Bookkeeping is an independent and work stage in the sense that is that cannot be performed based on the based on the standard and operating procedures. However, accounting is entirely depend on bookkeeping without the data provided by the bookkeeper. The accountant has nothing to analyze regarding special knowledge. Bookkeeping does not require advanced academic or professional skills. A basic understanding of debit and credits is often sufficient. Accounting, however, requires a specialized skill, a deep understanding of accounting standards, and the ability to apply judgment in complex financial situations. This is why we typically see junior employees handling bookkeeping, while senior officers or qualified accountants handle the accounting functions. When do these activities take place? This brings us to the time of transaction. Bookkeeping is a real time activity. Entries are made on the same day the transaction occurs. It is a continuous process. Accounting work, however, is typically periodic. While some analysis is ongoing, the heavy lifting of accounting, summarizing, and interpreting is usually done at the end of financial or calendar year. Furthermore, we must look at liability. A bookkeeper is a generally not held liable for the high level accountancy work or the strategic decision based on the data. However, the accountant bears a significant burden. The accountant is often held liable not for only their own analysis but also for ensuring the work or of the bookkeeper was accurate. They are the ultimate custodian of the financial truth of organization. In the final section of our comparison, we look at these adjustments and final statements. Bookkeeping does not involve making adjustments for outstanding expenses, prepaid items, or rectification of errors. It simply records what is accounting. However, sees this adjustment as necessary for a complete and true and fair view of the business. Finally, the output differs. Bookkeeping includes laser totals and balancing, which leads to the creation of a trial balance. But it stops there. Accounting takes those balances and transform them into trading account, the profit and loss account, and the balance sheet. Without accounting, a business would have a list of numbers but no understanding of its actual profit or loss. Before we move on to the terminology, let's quick recap this section. We have learned that bookkeeping is a clerical daily recording of transactions, while accounting is analytical periodic process of interpreting those records. Bookkeeping is a foundation, accounting is the superstructure. One of is performed by junior staff, other is performed by senior professionals. Remember, bookkeeping tells us the history while accounting provides the strategy. Now that we are understanding the framework, we are ready to look specific terms that fills this framework. Let's dive into the essential vocabulary of the business world. To speak the language of finance, we must define our terms precisely. We begin with the most basic business. In this context, business refers to any trade, manufacture, or enterprise undertaken with the primary motive of earning profit. If there is no profit motive, it may be a charity or a hobby, but it's not a business in the accounting sense. Next is the transaction. A transaction is an exchange of goods or services for a valuable consideration, usually money. It is the event that triggers a bookkeeping entry. Ask yourself, if a manager gives a speech, is that a transaction? No, because no monetary value was exchanged. That if that same manager buys a laptop for the office, that is a transaction. Only events with a financial character enters our book. To speak the language of business in the world of commerce, we deal in goods. These are commodities in the business, raw material, manufactured product, or even services. If a furniture store buys a desk to sell, that desk is goods. If they buy a desk for the secretary to use, that desk is an asset. It's all about the intent. Now let's talk about discounts. A discount is a deduction allowed to increase sales or encourage payment. We have two types. First, the trade discount, which is a fixed percentage of the listed price given at the time of purchase. Second, the cash discount, which is offered to customers to encourage them to pay their liabilities or bills promptly. Why do we separate them? Because trade discounts are usually not recorded in books of accounts, while cash discounts are. Unfortunately, not all businesses dealing ends successfully. This leads us to bad debts. A bad debt is an amount that cannot be recovered from a debtor due to their dishonesty, death, or insolvency. It is a loss that must be accounted for. This brings us to a major concept, liability. A liability is an obligation the business owes to outsiders. The fundamentals formula here is liabilities equals asset minus capital. We categorize them into long term liability, like debentures or loan taken for several years, and current liabilities, which must be paid within a single year, such as bills payable, creditors, or bank accounts, overdrafts that in the bank accounts. Knowing your liabilities is the first step in understanding your financial risk. On the other side of the balance sheet, we have assets. These are resources owned by the businesses that provides future economic benefits. We dive into four main categories. First, fixed assets. Fixed assets are those assets held for long-term use like land, building, and machinery. They are not for resale. Second, current assets are those that can be converted into cash quickly. Second, current assets are those that can be converted into cash quickly, usually within a year. Example include a stock of goods, cash in hand, and debtors. Think of the current asset as the fuel that keeps the business running day to day, while fixed assets are the engine. The third category is wasting assets. These assets are that consumed or exhausted through use, such as mines, oil wells, or quarries. As you extract the resource, the value of assets decreases. Finally, we have 50 years assets. These are not physical assets at all and have no market value, but they are treated as assets in the books of accounting purposes. Example include goodwill or prepaid expenses. They represent expenses that have been paid but whose benefit will be realized in the future. How can something with no market value be an asset? Because it represents a stored value or a right that can company owes, which will help generate future revenue. Let's look at who owes us and what we have. Debtors. Debtors are persons or entities who owe money to the firm, usually because we sold them goods on credit, stock, or inventory represents the goods that remain unsold at the specific date. We track opening stock at the start of the year and closing stock at the end of the year. Related to debtor is the term receivable. This is the broader term that includes all amount receivable by the firm, not just from the sale of goods, but from all other resources as well. If a debtor is a specific person, a receivable is the general category of money coming in. Conversely, we have creditors and payables. Creditors are the people or businesses To whom our firm owes money, usually because we brought goods or services from them on credit. We just have receivables, we have payables. This includes all the amount firm is obligated to pay others, extending beyond just trade creditors to include things like taxes or interest in a healthy business. Managing the relationship between your receivables and your payables is the key to maintain liquidity, the ability to pay your bills on time. Not every outflow of money is an expense. A loss occurs when an event happens against which no profit or no benefit is received. For example, if goods are stolen or destroyed by fire, that is a loss. There is no service or product gained in return for that cost. Who bears these losses? The proprietors. The proprietor is the person who invests the capital and bears all the risk of the business. They are the ultimate owner. When a proprietor takes money or goods out of the business for their own personal use, we call it drawings. It is important to remember that under the business entity concept, the proprietor and businesses are treated as separate unit. Therefore, drawings reduces the owner's capital or total investment in the firm. Now we get to the core of the income statement. Revenue is the total inflow of assets, usually cash or receivables resulting from the sale of goods or services. It increases the owner's equity. However, to earn revenue, we must incur costs. An expense is a cost incurred during operation in a specific accounting period. When we subtract expenses from revenue, we get income. So, income equals revenue minus expenses. It represents the actual profit earned during a period. If you sell a shirt or a $50 that shirt for $50 that cost you $30 to make, your revenue is 50 minus 30 and your income is 20. It is important to disguise income from a gain. While income comes from regular business activity, a gain is an irregular or incidental profit. For example, if a clothing store sells an old jewelry van or old delivery van for more than its book value, that profit is a capital gain, not regular income. Next, we have purchases. In accounting, this term is used specifically for the buying of goods meant for resale or for use as a raw material. Buying a computer for the office is an asset purchase, but buying fabric for a garment factory is purchases. This distinction is vital for calculating the cost of production. When we sell those goods, we generate sales, which can be either for cash or on credit. From these sales, we calculate two types of profits. First, gross profit, and second, net profit. Gross profit is the surplus of sales revenue over the direct cost of goods sold. It does not take account into office rent, salaries, or advertisement. Net profit, however, is the final profit remaining after deducting all the expenses, both direct and indirect, from the total revenue. If gross profit tells you how efficient your production is, net profit tells you how efficient your entire business operation is. Which one do you think investors care about more? Usually, it is net profit, as it represents the actual money available to the owner. Our final three terms are foundational. Cost of goods sold or COGS represents the direct cost attributable to the production of the goods sold by a company. This includes the cost of materials and direct labor. Equity refers to the net worth of the company, often called owner's equity. It is what is left for the owners after all the properties or all the liabilities are paid. Finally, capital is the specific resource, money, or assets invested by the proprietor to start and maintain the business. Capital is the lifeblood of the firm. Without capital, there is no asset. Without asset, there is no production. And without production, there is no revenue. We have just covered a vast landscape of terminology. Let's pause and recap. We have defined the players like proprietor, debtors, and creditors. We have defined the stuff, goods, assets, and stocks. We have defined the actions, transactions, purchases, and sales. And we have defined the results like revenue, expenses, income, and gains. Understanding these terms is like learning the alphabet of finance. Once you know the letters, you can start building the sentences, which in our case are the financial statements. Do you feel confident to distinguishing between an asset or an expenses? Remember, an asset provides future benefit while an expense is a cost for the current benefit. Now let's see how all these pieces fit together in a flow of information. Now let's look at the big picture relationship between these concepts. Everything begins with business transactions. These are the raw material, raw events. From there, we entered the stage of bookkeeping, where these transactions are recorded in the journals and then posted into the lasers. This is the data collection phase. Once the lasers are balanced, we move to the trial balance. The trial balance is a crucial statement that bridges. It lists all the laser balances to ensure that the total of debits equals to the total of credits. If the trial balance does not balance, we know there is an error in the bookkeeping phase. It acts as a gatekeeper before we move into the more complex world of accounting. Once the trial balance is verified, the accounting phase truly takes flight. Here, the accountant performs classification, summarization, and necessary adjustments or rectifications. This leads directly to the preparation of final accounts. This includes the trading account to find gross profit, the profit and loss account to find net profit, and balance sheet to show the financial position. But the process does not end with the report. The final and perhaps most important step is analysis and interpretation. This is where we use the reports to understand the firm's profitability and solvency. This is the step where stakeholders like bank managers or investors look at the numbers to make informed decisions about the company's future. Reflection on this flow, we can draw several key insights. First, bookkeeping is the undeniable the foundation. It provides the raw material. Without it, there is no data. Second, the trial balance is more than just a list. It is a diagnostic tool that ensures mathematical accuracy. Third, accounting is an evolutionary step. It informs raw data into meaningful information. Fourth, final accounts are the structured output of this entire process. And finally, the ultimate process of this entire chain is analysis and interpretation. Why do we go through all this trouble? To provide clarity in a complex economic environment. Without this structured flow, a business is essentially flying blind. As we approach the conclusion of our lecture, let us synthesize what we have learned. Bookkeeping is a mechanical heart of the financial system. It is concerned with the systematic recording of transactions as they happen. It is a clerical task limited in the scope of journals and lasers and is typically the responsibility of junior staff. It does not look for the why, it simply documents the what. It is the essential first step that ensures every penny is accounted for in the daily operation of the business. Without the discipline of bookkeeping, the sophisticated analysis of accounting would be impossible. Accounting, however, is the brain that directs the body of the business. It goes far beyond mere recording. It involves the high level task of classifying, summarizing, and interpreting the financial data. It requires a specialized senior professional who must ensure the accuracy and integrity of the financial story. Accounting takes place where balance sheet lasers and crafts them into trading account and profit and loss account and balance sheet. It provides the true and fair view of the business that regulators
owners, and creditors demanded. It is the tool that performs a pile of receipts into the strategic roadmap for growth. And finally, remember that bookkeeping and accounting are not rivals, they are partners together. They form a backbone of financial management. Bookkeeping provides the raw data, accounting transforms that data into intelligence. As a graduate learner, your goal is to understand the mechanics of the former so that you can master the analysis of the latter. Whether you are managing a small startup or a multinational corporation, whether you are managing a small Whether you are managing a small startup or a multinational corporation, these principles remain the same. Accuracy in recording leads to clarifying in reporting, which leads to wisdom in decision. We have now established the framework and vocabulary. In our next lecture, we will begin looking at the actual rules of recording. The principle of double entry bookkeeping. We will explore how every transaction affects two sides of accounting equation and how we translate real world events into the language of debits and credit. Until then, review the 26 terms we discussed today. Try to identify these elements in the financial news or in the business you interact with daily. See you. See if you can spot a current asset or identify a business transaction in action. Thank you.